Welcome back to Count Me In, IMA's podcast about all things affecting the accounting and finance world. This is your host, Mitch Rochong, and I would like to say thank you for coming back and listening to another episode of our series. The guest speaker for episode 145 here today is Claire Chandler, an acquisition, integration, and onboarding specialist. Claire is a corporate survivor who draws upon almost 30 years of business, leadership, and consulting experience. One of her specialties is business value creation. In this conversation, you will hear her discuss what finance and accounting often get wrong when calculating business value. Keep listening, as you will now hear from Claire Chandler with Adam Larson.
So Claire, according to stockanalysis.com, I was reading that there have been around 703 IPOs in the U.S. stock market in 2021 as of around mid-August, which is when we're recording this, which is 331% more than the same time in 2020. So needless to say, there's been a lot of business valuation happening as companies seek to grow and expand. So as we start off our conversation, can we talk about what drives the value of business?
Yes, please. Yeah. What a great question to open up with, right? So, back in the day, we lived in an industrial economy. I think a lot of people make the mistake of thinking we are still there. And back when we were more industrial, close to 100%, about 95% of the value of a business, any business, was driven by tangible assets, right? So things like a company's technology, the products that it made and sold, their operations, and of course, their financial capital. But we don't live in an industrial economy anymore. We actually live in an intellectual economy. That economy is dependent primarily on the output of the human mind. And I know that sounds bizarre when I say it out loud, but think about it. We're really driven by intangible assets. Company's brand, its services more so than its products, the intellectual property, the knowledge in the heads of the human capital, right? And so with this shift that has happened gradually, but we are fully ensconced in an intellectual economy, that shift also changed what drives business value. So before it was almost entirely driven by tangible assets. Today, it's well over 72% driven by the intangibles. And we're seeing this across every industry. And in some industries, if you look at, say, tech and pharma, they're close to 100% driven by intangible assets, right? The products of the human mind. And so it's really critical that businesses pay attention to that.
And then on top of that, you not only are you having to worry about the numbers and the financials, you have to start worrying about things like ESG and sustainability are becoming more and more essential that you have to report on. So not only the mind, but also how is my business affecting the environment?
Yeah, and it's interesting to that point. The markets have shifted in that way as well, right? The SEC has become more stringent and has raised its expectations on what companies do, not only in the sustainability space, but also in terms of how people are treating and nurturing the human capital. So the markets have shifted, the economy obviously has shifted, and the more successful businesses have embraced this and sort of incorporated that into their business strategy.
So as we're thinking about businesses and getting investors and growing IPOs, the other thing I saw an article on Fortune the other day. It was saying that there's been over $2 billion of mergers and acquisitions activity in just 2020 alone. I think that was through the beginning of July. We're now to mid-August. How can investors reduce the risk of investing in the wrong company, especially with so many different factors that we were just talking about?
Yeah, it's a huge question. And obviously, the bottom line is investors want to make their money back in multiples, right? And so the way to reduce the risk starts with their value creation plan hypothesis. They need to be crystal clear on their end goal, right? The clearer they are on what they want to get out of that portfolio company on the back end, whether it's a holding period of 3 years, 5 years, even longer, the clearer they are on that going in, the easier it is on the front end to make sure that the company they're evaluating actually has the capacity and the capability to deliver that return for them. Because obviously that is the goal. Whatever form it takes, that investor wants to get the most bang for their buck. So they've got to be really, really clear on the hypothesis going in on what they expect to get out of their VCP.
So then on the other side, what should companies be doing to attract the right funding? Because you got to think about their side too.
Yeah, absolutely. And it's all about the right funding, right? To your point. And it's a similar process for companies on that side that are looking to grow through the backing of the right investors. So they need to be really clear on their end goal as well. And it's probably not as far out for them. It may not be 5 or 10 years. It may be, 12 months to 36 months, but they need to deeply understand where they want to take their business and how ready they are to grow in that direction with or without funding, right? So, and I say that to really make this point. A lot of startups make this fatal mistake of believing that money is going to solve everything, right? We can get to the next level if only we have the financial capital. And that's totally false. They really need to evaluate their capacity and capability, just like the investor is going to do before that investor comes in and does that for them and finds that they're not really ready to grow and scale. So it's not just about getting investment. It's about understanding why you need that investment. Are you ready to take that investment, and who is the right source of that funding?
Yeah, because somebody could come to your startup and say, we're going to give you $2 billion, but if you're not ready to grow, then that $2 billion would just kind of go to waste.
It's going to be a wasted bet on, and both sides are going to be complete failures in that regard, right? Especially if you're talking about an investment to the tune of, $1 billion or more. An investor is not going to do that on a wish and a prayer. They really do need to be very, very thorough in vetting the company they're about to put their money behind. And the company itself has to be really self-aware and disciplined before they take on that level of funding.
So I can imagine that there's going to be mergers and acquisitions that aren't successful. You can read about the famous ones when I forget which company bought AOL. No one really knows what AOL is anymore. Stuff like that. Why do most mergers and acquisitions fail to create value?
Hey, so in my defense, I still have an AOL email account. It's the oldest one I have, and I'm a little bit nostalgic, I guess. So I still use it for personal email. But I digress. Yeah. So Bain and Company, it's one of the big, research houses, and they do a lot of work in this space. They put out a global private equity report earlier this year that found that 58% of M&As fail to create value. And one of the main reasons that they fail is because they over-index on the tangible side, right? They over-index, they over-focus on the due diligence side, the integration side, and the management side post-close on those tangible assets that we talked about. And what's interesting is that same study by Bain found that the number one reason deals fail is the quality of the human capital within that portfolio company, specifically the top management team. And so what the sort of the good news about that, and I'm an eternal optimist, so I always look for the silver lining. The good news on that side is that the quality of that top management team, which again is this combination of their capacity to get to the next level and their capability to put the horsepower behind it in terms of depth of talent, et cetera. It's also the number one reason deals succeed. So if you look at that in black and white, if that is the number one variable or wild card is your human capital on both the failure side, the success side, why wouldn't you spend way more time and attention and effort on evaluating that?
Mm-hmm. That makes a lot of sense. Do you think that there's an element of the virtual capital, like the things you can't see, the intangibles, besides the human capital, that could be an element of that it's hard to measure, that you can't really see?
Yeah, that's always the biggest, I think, mental stumbling block when I talk to folks in the investment community, and I say you really need to spend more time and attention measuring and assessing those intangibles. And invariably, they come back to me and they say, okay, that's great. I get that that's the biggest wild card. I get what Bain is telling us. I get that just from past experience, the human behavior, performance, capability, capacity, all those things are the biggest wild card. And then the products of that, right? The brand, the ability to innovate, the ability to solve problems, all of those things. But then they follow that up with saying, but they're humans. We can't measure that. They're unpredictable. They're total wild cards. And the answer, in fact, is you can measure that. There are ways, and in the work that I do, there are tools. They are scientifically validated tools that will measure and assess these things that we're talking about: the capacity, the capability, the mindset, the coachability. Often, that's a big stumbling block for an investor coming into a company and saying, "You got from point A to point B. We want to see if you can get to point C." There are ways to validate before you put your money behind that business, whether that top management team can actually receive that coaching, that advice, and change the way that they do things from management by chaos to a more structured way to get to the next level.
So as I'm kind of thinking about how this connects to our audience, the accounting and finance teams, what can they do right when calculating business value? Because I'm sure that they'll be integral in calculating the business value when it comes to ventures or IPOs and all that stuff.
Yeah, they are absolutely integral. And I honestly think our friends in finance and accounting have the best opportunity to turn the tide, right? To sort of tip the scales away from over indexing on tangible assets and really incorporate into their process more of an evaluation and valuation of the intangibles. So, how do you do that? Well, instead of just focusing on quantifying headcount, quantifying customers, taking a look at, have they gotten into any legal trouble in the past, counting up all of the widgets and the tangible assets that make up a company, really upskilling, starting a due diligence that, their process for evaluating the intangible side, which we already know across every industry drives the majority of the business value. So they need to find ways to evaluate that capacity and capability, specifically at the top management level. But they also need to evaluate the depth of the talent behind them. And if they do that, if they find ways to do that, or if they find people like me, we are out there to help them do that, they're going to be able to help their companies invest in the right businesses with far less risk and far more confidence and success.
Are there specific things that they should avoid when doing that valuation? I know you gave some great pointers there, but what are some steps that they should really avoid, or some red flags they should look out for?
Yeah. So it's interesting that you say red flags. So I in the work that I've done, in some of the valuations that I've done for investors, and even on the company side, I have a sort of a framework that I use, and I put together a checklist that I can give your audience the link to. They can go out and grab it. But it's a great way for companies and investors to sort of do a self-check on it. It basically comprises the 11 dimensions that drive performance and profitability. So the checklist kind of takes you through each of those 11, and you can sort of self-assess on the company side, or as the investor looking into a prospective company, just sort of rate those things following the checklist. And what it will yield for you is it will help you identify, what are my top 3 profit levers, right? So what are the 3 dimensions that we have in spades that are competitive advantages for us, that if we put the right horsepower, the right attention behind it, they can really drive the business forward. And conversely, it will help you uncover what are the top 3 risk flags, red flags, potential derailers that could sink your business. And so investors have used that checklist, yes, for the profit levers, but more specifically to say, are there any answers in here that are deal breakers, that if we knew this up front, if we paid some attention to this and follow this checklist, would make us walk away? So it's really, really important from both sides. One, to help you press your advantage and play to your strengths, and also to make sure that you go in with eyes wide open and verify before you buy.
Yeah, verify before you buy is I think it's something that we all should keep in mind, no matter what you're doing, for sure.
Yeah.
Well, Claire, I really appreciate you coming on our podcast today, for sharing your insight. I know that our audience will really be greatly receptive to it.
Well, it's my absolute pleasure. If anyone in your audience does want to grab that checklist, they can go to my website. It's talentboost.net. /checklist is the fastest way to get to that checklist. Otherwise, if you just go to talentboost.net, there's a button at the top, click on checklist. And And as you kind of go through the checklist, if you have any other questions, you want to reach out and talk specifically about where you are in your business, have somebody like me can help you get ready for your next level, go to the top of that same page. There's a big button that says book a call. Click that button, pick a time, and let's chat.
This has been Count Me In, IMA's podcast, providing you with the latest perspectives of thought leaders from the accounting and finance profession. If you like what you heard and you'd like to be counted in for more relevant accounting and finance education, visit IMA's website at www.imanet.org.